Hello and welcome. Today I will be analyzing Nike, and today we'll be going a little easier. I will be expanding a little bit more on the ratios and what the metrics actually mean in order to show you on example of Nike how to pick and value companies. So first let's look at Nike stock price performance, because whatever we do we need to compare it to the price. If the business is great but the price is super expensive, then there is no way of making money on that business. But happily for us, Nike is after around 70% price decline from the top. But of course at the top, at the price of 180, the price was after a significant movement upward from the COVID 2020 bottom of around 60. It moved in 2 years to the price of around 180. So it was a very strong movement. The price tripled over the period of 2 years, giving investors 200% return from the bottom, so 200% just clean profit from the bottom. And right now that situation completely flipped from the very high optimism and the price skyrocketing upward. Now we are seeing a significant downward move, and the price dropped from the 182 back to around $60 per share. And remember that currently that $60 per share is less because of all of the inflation. The dollar has lost some of its value, and also in the period the company was buying back its shares, so the amount of shares that are trading on the market decreased. So right now for the same price of $60 we are getting a little bit more of the business for the same price. So this current price is actually a little bit lower than the price in 2020. Right, and let's look at the percentile ranking. This data here, I collected it from NKE. It's a premium financial data website, and here this is my favorite metric. It's a percentile rank. It works in a way that we compare the current metrics to the history of this company. So for instance, for Nike, the current price to sales ratio is 1.9, and that is this is the first percentile, meaning that only 1% of times over the period of last 10 years this company has been traded at this low multiple of 1.9 for price to sales ratio. Price to sales ratio compares all of the revenues coming in to the current price of the company. So if the company stock is at $60, the price to sales ratio of 1.9 means that the company is doing $30 of revenue per year. And only 1% in the whole history of this company has this value been lower. So it is very low. And we are talking about the price of around $60 per share. So if in the future this price changes, you need to remember to also account for that. And we can see that from the valuation multiples, all of those multiples are very low, other than price to earnings ratio, when the percentile rank is at 64, meaning that more than half of times this company was traded with this multiple price to earnings ratio at a lower level than it currently is. But what is very important is the fact, one second, I just wanted to check if everything is recording. What is important to note about price to earnings ratio is that earnings can be artificially lowered, so it's not a very good metric, because if we generate a lot of, for instance, investments, some kind of expenses, that will lower the earnings. But if you look at all of the other metrics, you can see price to book ratio is at a rather high 6.4, but for this company This is the lowest reading that we ever saw over the period of last 10 years. And yeah, the same goes to price to gross profit, enterprise value to sales, etc. So yeah, looking from the valuation perspective, this company might be cheap, but it's also important to look at the cash flows to determine what are the real earnings of the company, what are the cash flows to the firm. Right, and we can see in here margins and profitability. Currently those margins, even though the gross margin is at 41%, so if they sell something for $100, $41 out of that is their profit, so it's really good. However, it is currently at a percentile rank of 0, meaning that this company has never had such a low margin. Well, 40% is still good margin, but compared to this company in last 10 years, it used to be better. Right, and let's look how this company is doing, and we can see that this company has been growing, well, not very fast, but in 2022 it was 5%, 2023 10%, after that it was around 0%, and the revenues in 2025 actually decreased 10%. So this is a very problematic sign that something is happening inside of this industry, inside of this company. I heard that the streetwear, which Nike is a big part of, is currently struggling, so that might be also reflected here. Cost of revenues, it also dropped down actually more than the revenues, meaning that they achieved a little bit of operational efficiency, lowering their costs a little bit compared to the revenues. And operating income and expenses, it looks similar, very good numbers, and then in 2024 and now in 2025 those numbers went down quite a lot. Alright, and what we can see that in 2025 also the net income dropped around 40% from the previous year, so this is a huge decrease in net income. And let's look at the margins. They decreased quite a lot. In previous years the return on assets used to be around 10%. In 2025 it dropped to around 6%. Return on equity also dropped significantly from 40% in 2024, nearly 50% down to 23% in 2025. And that can be seen in all of the margins, with the net margin currently at 7%. And is this company risky? It starts generating less profits. So let's see at the debt structure. So the total debt to equity is 80%, total debt to capital is 44%. And the easiest, I think, metric to analyze is the total liabilities to total assets, and it's at 72%. That means that for each $100 of assets, there are 62, those are assets, there are $62 of liabilities. So the assets are a little bit more than the liabilities of this company. And let's look at the interest rate coverage, because if this company cannot cover its interest, then they will go bankrupt. But we can see that earnings before interest are 10 times bigger than the interest, so they are not paying a lot of money on that debt. They are easily able to cover the interest expense with the cash flows that the company is providing, even after the decrease of income. Right, and let's look at the cash flows right now. So we can see the cash flows were strong only in 2025. they dropped significantly, around minus 50%. So that was a significant drawdown, but we can see that this year 2025 this company also invested a little bit. In here we have some capital expenditure and also investment in market and equity securities, but there we had been generating profits from this part, so they were selling something on the equity market, security market, and earning money from this. And cash flow from financing, this is something that saves this company. And in here we can see that there is a lot of repurchase of common stock, so that means this company is buying back shares from the market, increasing our positions. So for instance, if there were previously 100 shares in the market and you owned one of those shares, you owned 1%. But if this company is buying back shares, so the amount of shares goes down, let's say it goes down to 50 out of from 100 to 50. So now when you own one share, it's 2% of the business. So this is very good for shareholders. What else? They are paying dividend, around 2 billion in dividend paid out, or maybe this might actually, no, this is 2 billion, right? More than 2 billion of dividends paid out, but of course per share that's around 2-3%, so it's nothing super amazing. And yeah, those are the most crucial metrics for Nike. So what is for sure visible is the drop in operating cash flows, and it's a significant drop of around 50%. So it's important to analyze it and further understand, is this drop something that will continue into the future, or is it just a short-term problem? Right. Thank you very much for listening, and I hope this will help you doing your own fundamental analysis a little bit into the future. Alright, so that's everything for today. Thank you very much, and yeah, have a great day.